Imagine your money doing two jobs at once, growing your wealth and shrinking carbon. That's the promise of green ETFs. In the next few minutes, I'll show you how they work, how to avoid the biggest traps like greenwashing, and a simple step-by-step checklist you can use today. Stick with me till the end and you'll walk away with a clear plan to invest with purpose without getting lost in jargon. First, what exactly is a green ETF? Think of an ETF as a basket you can buy with one click. Instead of owning a single company, you own slices of many companies at once. A green ETF fills that basket with businesses focused on clean energy, batteries, smart grids, efficient buildings, water solutions, or other climate-friendly technologies. It's a shortcut to diversification in the sustainability space, no picking winners and losers one by one. Why bother now? Because the energy transition needs capital, massive capital. International energy experts say global clean energy investment must ramp up sharply this decade for the world to hit its climate goals. In other words, moving the needle requires not only policy and personal habits, but also where capital flows. When you buy a green ETF, you're signaling to the market, build more of this. But here's the honest truth. The ride can be bumpy. Clean energy stocks had big runs in the early 2020s, then many stumbled when interest rates rose, supply chains snarled, and politics shifted. If growth stocks are a roller coaster, some green themes are the front car. That doesn't make them bad. It just means you need a seatbelt and a plan. So what's the upside of using ETFs versus picking individual stocks? Three big things. 1. Diversification. If one solar manufacturer struggles, you're not sunk because you own a spread of players across the value chain: power producers, component makers, software, and storage. 2. Simplicity. You can buy and sell during market hours and see the price in real time. 3. Cost. Many ETFs charge lower fees than actively managed funds, and the costs are printed on the fact sheet. Now, let's talk about the elephant in the room: greenwashing. Not every fund with clean, sustainable, or ESG in the name is what you think it is. Regulators have noticed. In recent years, the U.S. Securities and Exchange Commission tightened its names rule, which basically says, if a fund's name suggests a focus, like ESG or clean energy, then at least 80% of its assets should actually match that theme. The SEC has also brought enforcement cases against firms that overstated their ESG claims. Bottom line, the guardrails are stronger than they used to be, but you still need to look under the hood. So how do you choose a green ETF like a pro? Use this bright green blueprint. Step 1. Define your why. Are you aiming for impact, returns, or both? If impact is primary, you may prefer funds that concentrate on pure play solutions. Think solar, wind, or battery storage. If returns with lower swings matter more, a broader sustainability basket that includes utilities, efficiency, and grid infrastructure might suit you better. Your why is your compass. Without it, you'll chase headlines. Step 2. Pick your lane. There are several: clean energy generation, like solar and wind; grid and storage, which includes battery makers and transmission players; energy efficiency and green buildings, from smart HVAC to insulation; water and waste, covering treatment, recycling, and circular economy; and green bonds, where your money finances climate projects through fixed income. Imagine these lanes as tools in a toolbox. You don't need every tool for every job. Start with 1 or 2 that match your goals. Step 3. Stress test the story. Open the fund's fact sheet and prospectus. Yes, it's a snooze, but give it 5 minutes. What index does it track? What exactly qualifies a company for inclusion? Is it revenue-based, meaning a big chunk of sales must come from green activities, or is it looser, more involved in the theme language? Revenue purity matters. A fund stuffed with companies that make only a tiny fraction of revenue from climate solutions won't move the needle the way you expect. Step 4. Inspect the holdings. Scan the top 10 names. Do they match the theme in your mind? If you see oils, coal, or tobacco hiding in there, that's a red flag. Check geographic spread too. Clean energy is global. A fund overly concentrated in one country can carry policy risk. Also peek at sector weights. If 70% is in one sub-industry, expect bigger swings. Step 6. Know the numbers that matter. Expense ratio, lower is better, all else equal. Liquidity. Look at average daily volume and the bid-ask spread. Tighter spreads mean cheaper trading. Tracking difference. Compare the fund's performance to its index over time. Big gaps can signal hidden costs. Rebalance rules. How often does the fund refresh its holdings? Quarterly rebalances can keep exposure pure, but may increase turnover. Step 7. Identify the risk drivers. Green ETFs are sensitive to interest rates because many clean energy projects need financing. They're sensitive to policy. Tax credits, incentives, or tariffs can swing sentiment. They're sensitive to supply chains. Think polysilicon, rare earths, or battery metals. Don't just ask, is this a good theme? Ask, what could go wrong and am I okay with that? Step 7. Position size and timing. Treat thematic funds as satellites around a diversified core. For many investors, that might mean a modest allocation rather than betting the farm. Consider dollar-cost averaging, buying in small amounts over weeks or months to reduce bad timing risk. Set a simple rule to rebalance once or twice a year. It's like gardening. Plant, water, prune, repeat.
Let's make this concrete with 2 examples. A pure-play solar ETF is like a speedboat, nimble, exciting, and quick to react to news. It can fly when panel demand spikes, and it can slam when oversupply hits. A broader, clean energy ETF that mixes generation, utilities, and storage is more like a ferry, slower, steadier, built to handle choppy water. Neither is better in all seasons. They simply serve different jobs in your portfolio. How about impact? If you want your dollars closer to shovel-ready projects, look at green bond funds. Your money finances things like wind farms, energy-efficient housing, or clean transportation, and you collect interest along the way. Just remember, a green label still needs verification. Reputable funds disclose how projects are selected and reported, so you can see where your money goes. A quick note on expectations. Sustainable investing is not magic. It won't go straight up, and it won't replace the need for a well-balanced plan. But as costs keep falling for renewables, storage scales, and grids modernize, the long-term runway for climate solutions is real. You're not just buying a theme, you're buying a decades-long build-out of infrastructure. Before we land, here's your 30-second bright green checklist you can screenshot or jot down. 1. Define your goal. Impact, returns, or both. 2. Choose 1 or 2 lanes. Clean energy, grid and storage, efficiency and buildings, water and waste, or green bonds. 3. Read the fact sheet. Index, inclusion rules, and revenue purity. 4. Check the top holdings and country mix. Do they pass your gut test? 5. Verify it's truly green. Look for transparent methodology and consistency with the fund's name. 6. Know the costs, expense ratio, spreads, tracking difference. 7. Size it smartly. Start small, dollar cost average, and rebalance on a schedule. If you follow that process, you'll avoid most of the common pitfalls, especially buying a flashy name that doesn't match your values. You'll also be better prepared for the inevitable ups and downs. Remember, the market is a voting machine in the short term and a weighing machine in the long term. By putting dollars to work in real solutions, you're casting votes for the kind of future you want and giving yourself a chance to benefit as that future gets built. Just a heads up, nothing in this video is financial advice. It's all for information only. Explore more tips on money and investing at Money Nova's website. Thanks for watching to the end. If this was helpful, share it with someone who's curious about sustainable investing.